welcome to our webinar this morning on the recent Labour budget, the budget for the working person. I'm Jonathan Skinner, partner here at Acuity. I'll be guiding you through today's session. Now, we're going to be jumping in today what this budget means for you, maybe the non-working person, for the business owners and entrepreneurs. And as you've all seen through your Twitter feeds, your news feeds, and digested enough by now, this is the group, entrepreneurs, business owners, that have been asked to contribute the lion's share of what is a very large taxation burden for what is also a very ambitious budget. So before we jump into the specifics of the meat and the bones of what we're going to be spending our time on today, we need to appreciate a little bit about how this budget impacts us at the top level, the macro level. And the key theme here that the smart people that be smarter than me that are contributing out there is that the high level, the very high level of government borrowing, the significant high level of wealth and company focused taxation to support the high level of public spending is not going to have the best impact on interest rates and inflation for us. The OBR have commented that interest rates are likely to stay sticky all the way to 2027. So this nice gradual decline that we've been enjoying since mini budget back in 2022 spoiled things for us. That decline is likely now to stall and stay roughly where it is for the foreseeable, with inflation supporting that. With high government borrowing and high government spending, the Bank of England are likely to want to respond to make sure inflation continues its downward journey, which is going to be a difficult process. So what does this practically mean for us at the high level? The answer is fairly obvious. So for our borrowing, for our financing needs, interest rates are likely to go up, or at least not go down anymore, which means access to capital and certainly the assumptions you make about the cost of your capital need to stay high. So planning ahead, getting ahead of your cash flow, seeking help with financing early is really the name of the game here. So in other words, it's time to brace for a little bit more of an expensive capital world that's going to be funding growth in the short term. Now, digging into the specifics, and we're thinking about what's happening in this budget, the first observation to make is that this budget is as much about what hasn't happened than what has happened. Right. So the halls of Westminster, the echo chambers, the rumour mill did a really good job at sending out a certain message out into the market. We were fearing high wealth taxes, so some form of new wealth tax perhaps was going to come on the scene. We thought capital gains rates might start to integrate with income tax rates. Well, that didn't quite happen. We thought that we might say goodbye to ISAs. That didn't quite happen. Right. So amongst all that fear and chatter, the introduction of the budget that we have seen has felt certainly a little bit softer. It's created a soft landing cushion for what actually still is quite a hard-hitting budget for those of us that run and own businesses and invest in property. Okay, so it is worth noting the things that didn't happen as much as the things that did happen here. So what are the specifics that we need to get into? So top of the pack, what everyone's been talking about is how are the new rules around national insurance contribution and minimum wage going to impact my business? Because it's not necessarily as clear as it is on the front cover. What's going to happen to capital gains tax rates? And certainly the incoming that a lot of us are having from clients at the moment is what's happening to my capital gains, my self-shares in my business. What can I do now? So that normally relates to what's happening to what people normally refer to as entrepreneurs relief, so business asset disposal relief. What's happening with that? Because that wasn't clear in the budget either. Also then visiting what is happening with both IHT, so inheritance tax and stamp duty, and how is that impacting my business succession planning, and how is that impacting my personal my personal capital plan and personal financial planning. So we'll touch on all those bits as we work through the specifics today. So Dan Corliss is going to kick us off, getting stuck into looking at particularly at the national insurance changes. So Dan.
Sure, yeah, of course. So yeah, as John alluded to, probably one of the worst kept secrets of our budget was looming changes to employers' national insurance contributions. So obviously a tax that all employers pay on any employee that earns over the threshold. Okay, so I think that the rule of thumb here, first of all, just to kick off and help everybody understand that we've seen a result of these changes ultimately mean that very different things are businesses who have 5 or fewer employees or 5 or more employees. So if you're a business with 5 or fewer employees, it's likely that this will actually work in your favor. It's likely that you'll actually pay less employers' national insurance than you were before. If you've got 5 or more employees, it's likely you're going to be paying more. I'll unpack that in a bit more detail in a minute. But essentially what we're looking at here, coupled with the increase to the national living wage or minimum wage that I'll talk about in a minute, is quite a meaningful impact to SME and business owners. Okay. Now, as you might be able to see or might have read in news articles, there are 2 or 3 different levers by which the government has played around with increasing taxes or reducing various different thresholds, giving away with one, basically taking away with one hand and giving with another. And I think what we're seeing here really is the impact of that being hitting different businesses very differently. So broadly, what we'll do as well, we've created a national insurance calculator or an NI calculator that will circulate around along with the recording of this webinar that helps you understand for your business what the impact is going to be for you. Okay, I mean we've got a worked example here. If I just outline quickly, that essentially maps out for a business that has an average wage of £30,000 for all of its employees. So you'll have some, of course, that will earn more than that and some that earn closer to the national living wage. But for businesses with an average of that £30,000, what is the increased national insurance that they're going to be paying under the new legislation? Okay, so we can see there that rule of thumb that I said before, 5 employees or less, you're likely to be paying less national insurance. And then the further you are above that marker, the more national insurance you're going to end up ultimately paying. Okay, now coupled with the increases to the national living wage, which were about 6.7%. Okay, so quite a marked increase, certainly catching up for a bit of inflation over the past couple of years. When you couple those changes together, that's quite a big impact on businesses who have several or more employees working at that national living wage. Okay, so for a typical business that might have, say, 4 or 5 employees on that national living wage or minimum wage, and perhaps 1 or 2 other employees earning 50 odd thousand as perhaps managers or sales directors, you could see an increase of £6,000 to £7,000 for a business that's at 6 or 7 people. And obviously, again, the same impact applies, that the more you have or the more people you have could mark quite a substantial increase on your overall cost of hiring employees, and ultimately, therefore, off your bottom line. Okay, so it's worth being aware that these changes come into place from April next year, and it's your duty as an employer to keep appraised of those changes and keep updated with all of those changes that need to be made, and also have thought through how it's going to impact decisions that you may be making over the next couple of years. We've had business owners talk to us saying that essentially, our employees have had a 1.5–2% pay rise overnight and not realised it. Okay, and ultimately there's so many places where that money can be recouped or can be recovered. We know it's not as simple in many businesses as just upping your prices and passing those cost increases on to your customers. So we're having conversations with businesses about delaying future hiring plans or how they model out salary increases that they planned to give to their employees to account for the deficit that we're seeing here from additional national insurance taxes. Okay, I was just then going to move on to one of the other key areas I think in the budget that it's worth us unpacking, which is capital gains tax. Now, this is another important one, a very important one to business owners and entrepreneurs. So just as a reminder for those of you who might not know, capital gains tax is a tax that essentially you pay when selling any asset of significant value, with the exception of normally your primary home or your primary residence. Okay, so the reason that this hits business owners hard is that this is the tax that you will pay when you sell shares that you might own in your company. Okay, so if you're exiting your company or you're succeeding from your company as a succession plan or phased retirement, these will be the taxes that you pay. Okay. Now, Alistair will come on to talk about in a couple of minutes some of the nuances around what we can do planning for that and how we might talk about that, unpack that in more detail. But from our perspective, what we're just looking at here is the high level changes. Okay. Now, John touched on a minute ago the view on entrepreneurs relief, or now as it's known, business asset disposal relief. So going back sort of 5 or 6 years, we used to have this wrapper that entrepreneurs could rely on, whereby the first 10 million of equity that you had in your business when selling your business would be in this nice, neat little wrapper, and it would be taxed at 10%. It was rebranded a couple of years ago to be called this business asset disposal relief, and that threshold of 10 million was cut to 1 million. So up until the budget recently, if you sold shares in your business and the equity you received was 1 million, the tax rate that you'd be paying on that would be 10%. Okay. Now there's lots of mixed messages and disinformation off the back of the budget about this entrepreneurs relief. Some people saying it's here to stay, some people saying it's not going anywhere. And actually, as the reality you might be able to see there is that it is being removed slowly but surely. So from April, it's going up to 14%, and the following April, so April 2026, increasing again to 18%. Okay, coupled with tax changes to the headline capital gains tax rate, moving up from 20 to 24%. That's quite a big impact on the net amount that you might take home from any sale to another buyer or passing on to employees, etc. Okay, so just as a bit of a worked example, again unpacking this trend to see how much this impacts you, particularly those, like I say, relying on that business asset disposal relief marker at the lower exit values. You can see essentially for a business that might have sold for £1 million, the tax that you're ultimately paying on this can now almost double over the next year and a half. At the £5 million pound mark, obviously we'll see again as that business asset disposal relief is pulled away slowly but surely, the tax that you're ultimately going to pay increases. But the big change is overnight and prior to the budget, where that headline rate, like I say, has gone up from 20% to 24%. So that's quite a marked increase for those, like I say, who are thinking about exiting their business and who are thinking about succession plans for their business. So, Alistair, is that the perfect point for you to pick up?
So I'll just jump in quickly here, because
what
I didn't mention at the beginning is that if you have any questions that are burning as we walk through this, there is the Q&A section of this webinar is open, so you can click the Q&A icon and post some questions. And what we'll plan to do is right at the end pick up some of these, all of these, depending on how they pick up. So yeah, please do ask your questions there. Alistair.
Hi everyone. So now that Dan's shared the headline rule changes, let's have a look at practically what these might mean for those contemplating an exit event. So by that we mean selling their business or otherwise looking for an efficient way to extract value that has accumulated within their company, and also for those considering longer term succession planning. Now remember, any tax changes such as the ones introduced in this budget are a planning opportunity. They don't have to be bad news. The only way that we guarantee that tax changes are bad news is if we fail to plan accordingly. So whether we're thinking about exiting, extracting value, or planning our estates, there is unfortunately not a universal solution or joker card that fits every scenario. The reality is that every company is structured differently, the profile of every business varies, the employee base of every company functions and thinks differently, and of course family dynamics are more or less unique to each family and hence to every family and owner managed business. So the main theme I'd like to get across here when talking to you from an exit or value extraction perspective and a succession planning outlook is for people to just please come and speak to us, so that on the basis of each individual's and company's circumstances, we can advise on suitable options for you. But let's kick off by having a look at the principal themes from an exit planning perspective, as they've now been impacted by the budget. So anyone contemplating an exit or a sale is, being the seller, more often than not going to prefer a share sale rather than a sale of their trade and assets. In some cases, the latter is good, but for now, I'd like to focus on a sale of shares by a founder or an owner-manager as an individual in their company. So we're not talking about a holding company selling a subsidiary or anything more nuanced like that. It's purely a founder or an owner selling their business. So, of course, just to kind of caveat that point, if extraction of value or realization of any profit is actually not of interest, as is sometimes the case, and you're only interested in passing down your company shares to your family descendants, then the good news is that provided your company's trading, and by that we mean actively pursuing trading activity rather than simply holding investments, and that does include a property rental portfolio for avoidance of doubt, then provided that's the case, something called gift holdover relief can be claimed to ensure that you, as the transferor, are not going to suffer any capital gains tax. And that remains unchanged following the budget. They haven't touched that. So that being the case, you just need to consider the 7-year clock for IHT if your company shares are worth more than $1 million, but we will come on to that. So if we assume that you're actually looking to sell your company or otherwise extract some of the hard-earned value you've accumulated in capital form, and you'd want to extract it in capital form, of course, to benefit from lower tax rates than those on income, you've typically got 3 options available to you. You can look at a straight sale to a third party, you could sell to a family successor-owned company, or you could look at a sale to your own employees, which is a new interesting dynamic that's emerging more and more. Each of these remains a possible option as a result of the budget. That hasn't changed things, but circumstances are going to dictate which is the most suitable. I think a third-party sale or a sale to a family successor company are pretty self-explanatory in terms of how they work. So I'm going to touch instead on the employee sale options. So one option remains a management buyout. A lot of clients we've found, and their staff indeed, tend to think that these are out of reach for them, mostly due to things like financing and securing that financing to pursue the deal. They're certainly not out of reach, though. We can demonstrate how if you come and speak to us, but we've executed plenty of these and they remain a viable option. Trusts can have negative connotations. A lot of people quite fairly believe that they're needlessly complicated. They certainly can be. But in the context of selling your business to employees, trusts are incredibly simple and a very effective tool. So selling to an EBT, so an employee benefit trust, essentially enables a company financed acquisition by that company's employees and is a really great outcome for all parties. So following this budget, timing is critical with CGT rates and business asset disposal relief changing, as Dan was alluding to. So we would strongly encourage anyone contemplating such an exit or capital extraction, or anyone who would just like to better understand those, to just come and speak to us sooner rather than later, to lock in those rates as they are now, the next milestone for business asset disposal relief being April 2025. Now, employee ownership trusts are kind of like a supercharged mechanism for selling to your employees, and you don't have to worry so much about the timings of rates changing and locking in existing rates. These were relatively unchanged by the budget. There were a handful of technical rule changes, but they're becoming increasingly popular with owners looking to exit. And for anyone willing to sell a controlling stake in their business to their staff, an employee ownership trust sale offers a full CGT exemption, which can of course be worth up to multiple 6 figures or even 7-figure sums of tax. Most companies are eligible for this. They again offer a really great outcome for everyone involved. So if anyone is interested in exploring this, we'd encourage you to reach out to us. Our expectation here is that EOT sales are going to become extremely more commonplace as a result of the rising CGT rates in this budget. So thinking
I think,
instead
Alistair, it's
now,
already about 1 in 20 businesses sell to an EOT already, right? So it's a well-trodden path for businesses out there, and I think there's people on this call which are already talking to us about doing these as transactions. But certainly in the coming months, you're going to hear a lot about EOTs. They're going to explode onto the scene as it is, as Alistair's saying, untouched by the budget in its most part. In the nuances, there were a few adaptations here, but it's going to become an increasingly useful route for businesses to exit to because of the 0% tax rate effectively on using EOT to exit.
Thinking more now about longer term succession planning. So we're not necessarily thinking about extracting value here. So if one of the exit routes that we've just explored, or kind of a lifetime lump sum or capital extraction from your company are not really within your plans, the budget has forced business owners in that position and their advisors into a bit of a rethink in terms of longer term succession planning. So for a long time now, before any real nuanced estate and IHT planning were put into place, the conventional wisdom has always been to maximize your pension contributions and simply hold on to your company's shares until you die. Now, pensions falling outside of your estate and trading company shares now qualifying, no longer qualifying for uncapped business property relief, mean that now for a lot of business owners there's a lot more to think about with your IHT planning, because you've got to think about the value of your pension contributing to your estate value, and because we've only got that £1 million allowance for our company shares, there are some more steps that we need to be thinking about taking if we want to shield our estates and our descendants from those IHT bills. So Phil is going to cover more detail on pension shortly. The key message from me here is around overall estate planning, and we're going to focus specifically on how your company shares must be a key focus now of that estate planning, whereas previously, as we said, you used to just be able to hold on to them and not really worry about them when you die. So as with exit planning, unfortunately, there is no one size fits all. Everyone's circumstances differ. So estate planning and succession planning is really a holistic process that you need to do with your advisor. So again, please do reach out for any support you need on that. Thinking about your company shares now, the key change from the budget is that trading company shares are now only qualifying for business property relief, full business property relief rather, up to that £1 million allowance. There's an effective 20% IHT rate on any value attached to those shares thereafter. So not 40%, above that threshold like everything else, but it's still not great, certainly not compared to how it was. And just for avoidance of doubt, shares in non-trading companies, including those dealing in property and investments, they previously didn't qualify for BPR at all, and they still don't, just for avoidance of doubt. So the key to navigating the impacts of this, as with most estate planning, is looking at how do we potentially take those shares outside of our estate to mitigate IHT exposure. Lifetime gifts remain a perfectly valid planning tool here, and they're still a very good option following the budget. So by that I mean, if you gift shares to your children and survive 7 years, great news for IHT, they're outside of your estate and that nothing's going to be chargeable there. The downside of that, of course, is that you're effectively giving up a degree of control and rights to dividends from your company, so it does need to be carefully thought out. Where the concept of control proves a bit of a stumbling block, rather than gifting shares directly to descendants, you could look at putting your shares into a trust with those descendants as beneficiaries. That enables an element of control to be retained, and it also mitigates any concern you might have that your descendants simply plan to liquidate everything when you're gone and buy Ferraris. So again, trusts are they're not as frightening or as complex as they're made out to be. So again, please reach out if they might be of interest. And certainly it's something that we would propose quite readily as a planning tool for you. Now, returning briefly to the exit planning theme, a market value sale of your company shares to a family successor company. Therefore, as we can see here, quite neatly knits together retirement planning, succession planning, and a way of funding one's retirement while ensuring business continuity. So that's definitely something worth thinking about. And I can see some of you on this call with whom we're already working on some of these great tools and solutions. So before I hand over to Phil, I'll just leave you with a reminder of the key messages here from a practical planning perspective. So whether you're thinking about exit planning, retirement planning, or succession planning, or most likely all of the above together, circumstances are going to dictate the best solutions. And we're very keen to explore these with all of our clients. Timing is absolutely critical now with getting ahead on all of those things. So please do get in touch. Well, thank you very much. I'll hand over to Phil.
Alistair. Thank you, Alistair. Phil.
Thanks, Alistair. My name is Phil Bryant, and I head up our financial planning team here at Acuity. And I want to try and talk about two things today: the impact of the budget on personal financial planning, and also the impact for our landlords and our property investing clients. So in terms of personal financial planning, and it's been touched upon already by the guys in the call, the big change for our clients and the thing that we're talking to our clients about and working with our clients on are the changes with regards to pensions. So the budget changes mean that from April 2027, pension funds which have historically always been outside of estate values, they will now form part of the taxable estate on death. It was quite an off-the-cuff comment when the Chancellor delivered this change, which doesn't really reflect the importance of what the change means. Firstly, it's a retrospective tax change, which that doesn't normally happen. It's not usual. And what she didn't say was from April 2027, these rules will change for future pension fund accrual, which some would argue would be a lot fairer. The rules will actually change for all previous and future pension fund accrual. So who does this affect? Well, for individuals that don't have a total estate value above the nil rate band, which is 500k broadly, 325,000 nil rate band and 175,000 residential nil rate band, so it's £1 million per married couple. If your estate value, including pensions, is not close to that level and not likely to reach that level in the future, then there's no real change, which I think is important to note. But bearing in mind, average residential property values are close to 400k and average pension funds are close to 200,000 just before drawing income, a lot of clients will be affected. For our clients that this does affect, we're actively looking at levels of pension funding. So the accumulation phase of pension funding and the changes in how our clients can potentially draw pension benefits in the future. Key emphasis here is maximising tax efficiency. So not to overfund the pension now and exploring how pension withdrawals are being made both now and in the future. Structuring retirement withdrawals needs to look at how we can either reduce pension values by redistributing tax-free cash lump sums or looking closely at partial or full annuitisation, which is converting element of the pension asset into an income stream. Historically, we as financial planners have normally advised clients that the last asset to access should always be the pension fund. Due to the superior death benefits, but now that advice is not necessarily always the case. Looking at other investment vehicles, investment bonds, for instance, I'm sure you'll all be familiar with investment bonds. Up until recently, they've been viewed as slightly antiquated and a little bit old-fashioned compared to the more modern platform method of investment via a general investment account or a GIA. These are now looking a little bit more attractive in certain circumstances because there is an ability to reassign the bond to another owner and also place that investment into a trust. So the investment bond is potentially making quite a significant comeback for inheritance tax efficiency. So if residential property and the pension fund is now valued at more than 1 million or trending close to that level, we are looking at ways in which we can reduce our clients' estate values effectively and efficiently. potentially lifetime mortgages or equity release plans. They provide an access to capital before death, which can then be distributed to beneficiaries, which is a really useful tool to keep estate values below that £1 million threshold. And talking of thresholds, it's important to note now that there are two quite significant cliff edge thresholds. £1 million is the first one, which is where the nil rate band ends for married couples qualifying for the residential nil rate band. So anything over and above that will be taxed at 40% on death. But there's also another threshold, which is potentially a little bit less well known, and that threshold is £2 million per person. Where above £2 million, the residential nil rate band starts to be lost. So that anything over 2.35 million, there is no residential nil rate band at all. So that reduces to purely 325,000 rather than 500,000. So we're talking to our clients actively about planning their asset values and how they are now looking to distribute those asset values to their beneficiaries. In terms of cash, looking at the outlook and future inflation, up until recently, John alluded to this earlier in the call, up until recently, there was very much an expectation as inflation had been reducing significantly, the cash rates would follow. And moving into 2025, we'd certainly see a sub 5% cash rate environment. This has potentially changed in the short term, and also note the fact that Bank of England today have voted to drop rates and they're down to 4.75 now, which they did at 12 o'clock today. Not a huge surprise. But this short-term view has changed, and we've got some short-term volatility in the cash market. There is some similarity on a much smaller scale to the reaction to the Liz Truss mini budget of September 2022, with the gilt market reacting to government spending plans, and this could affect short-term inflation with an increase which potentially could affect short-term cash rates, much as the Bank of England base rate has already come down today. There's different things in play there that are affecting those lending decisions. So the longer term view for cash rates and inflation is still fairly steady and potentially reducing, but the budget has put a little bump in the road, and that trajectory may be a little higher than pre-budget expectations. Can we pop on to the next slide, Jess? So the second part of what I want to talk about today is the impact on the budget for our landlords and our property investing clients, of which we have a number. And as John did earlier, I think it's worth looking at what didn't change in the budget, because we were hearing all sorts of horror stories pre-budget about proposed changes for property investors in a sector that has arguably already been hit quite hard in recent times. So what didn't change? Well, CGT didn't change dramatically, not in terms of property. There was talk of a special rate of 53% for additional property owners, which was a little bit toe curling, as you can imagine. And there was talk of a national insurance contribution requirement for rental income for landlords. There was talk of a change in the basic rate of dividend tax for our landlords in limited company. So there was a lot of significant changes muted pre-budget, and fortunately a lot of those changes didn't really come into effect, which is clearly positive. Although I suspect the concern for those changes may have made people dispose of some assets potentially unnecessarily. So CGT has really just been simplified and aligned, so there's not really a direct change for our property clients. But what did change, and what did change quite significantly, was an increase in the SDLT for residential properties, changing that surcharge from 3% to 5%. And this will have a significant impact for landlords looking to increase their portfolio properties. To highlight the point, £37,500 SDLT on a £500,000 property is expensive, and that will affect the planning process and ultimately impact the yield. And we're speaking to a lot of our landlord clients about potentially changing strategy and pivoting from the residential traditional buy-to-let market to the commercial or mixed-use market, because the SDLT scenario in that circumstance, as you can see there, is significantly lower at £14,500 for the same value property. So is there an opportunity in the wider property market to change strategy and look at those commercial or mixed-use property options? So expanding on the cash rate, mentioned earlier, the interest rate side of things, it will act in a similar way. As I mentioned, there's been a reduction today in the Bank of England base rate, which has come down to 4.75 from 5, but is the longer term view above or below 5? As I mentioned earlier, we have seen cash rates rise in the short term, and we've also seen mortgage rates rise in the short term since the budget. The 10-year gilt rates, which are quite significant in terms of the direction of travel for certainly short-term lending in this country. The 10-year gilt rates were at 4.2% pre-budget, and those are moving beyond 4.6% now. And that will absolutely affect short-term borrowing. However, we still believe that the longer-term view is a reduction in interest rates, but the budget has potentially slowed that down. And it's very much worth keeping an eye on that 10-year gilt rate to see that direction of travel and to see what could be happening in the short term, certainly for our clients who are looking at financing options. So we still believe that there are really good opportunities for our landlord clients, but strategies may need to be tweaked and lending will need to be really well sourced. There is still the strong argument to be holding properties in a company environment, but that reason is now not just for immediate tax efficiency. It is now important for those landlord clients that also have pensions, as the ability to distribute property assets within a company is much more efficient than doing so via personal name. And that really helps achieve successful succession planning. So to me, the key impact on both personal and on a landlord and property clients is the changes that need to be looked at and analysed with regards to achieving successful succession planning, because that IHT environment has changed for both. Hope that was useful, and that's all from me. Back to John.
Great, thanks, Phil, and thank you, Dan. Thank you, Alistair. So, and thank you everyone for joining us today. There's a lot to take in. I hope you found that a useful digestion of what's happening with the budget and how that's impacting your business, your personal finances, your investment outlook. So in closing, before we move to some Q&A, and there are a few bits popping in, certainly one of the messages we want to leave you with is that even though when there are tax changes and those tax changes are in the direction that you don't want to go, so it feels a bit heavy-handed, we always want to remind everyone that change does often lead to planning opportunities, and it is a chance for you to adapt and re-strategize where you need to go. So it is more important than ever to be talking to us, so talking to your client managers, talking to your partners, talking to anyone on this call about the things that you're thinking about or ideas that you have, or certainly directions that you're going your business. And certainly the number one question that I'm getting fired in at the moment by clients generally relates to exit planning at the moment, because it is these CGT changes that seem to be weighing down heavily on a lot of people at the moment. And there are certainly some time-bound things that can happen, and emphasising the time-bound piece between now and the end of the tax year, there will be a lot of people doing things in that period. So if you are thinking about exit strategies and things like this, you need to get ahead of the curve and start conversations early, because certainly the advisor and provider space is going to get very, very busy over the next 4 to 5 months or so leading up to that. So thanks everyone's time and insight. We've had a few bits of Q&A in. There is a question in from Jay that is particularly technical, which we might have to take offline, but let's, I think Alistair and Phil, as an IHT kind of focus one, it says if a company is being funded by shareholder loans, so talking about maybe a limited company where the directors have put a bunch of debt into the business to fund the business, does IHT apply to these amounts, or are they included within BPR, or business relief now it's called? Now, Alistair, if you want to pick that up straight away, if there's anything we can unpick here.
Sure. I mean, the decision of whether to finance your company via loans or equity is, has many considerations. IHT is one of them, and sure, if you die at that point you have loans outstanding to you due from the company, those do form part of your chargeable estate for IHT purposes. They don't qualify for business property relief. The closest you can get to debt financing that would still, of your company that would still qualify for business property relief would be to use use preference shares. But yeah, it's a drawback really of using loans. That yes, they're not going to qualify. Only the value of your shares will.
Okay, and actually that does sort of raise some other sort of questions, that some of the things that we didn't touch on today, because there's a lot of things that happen in the budget which we didn't talk about. But in terms of financing businesses generally, one of the things we did keep our eyes open for were any changes and impacts on EIS or SCIS funding, of which I know there's at least some people in this call I can see that have partaken in those methods. This is where businesses might raise money from private individuals in the UK, and those private individuals get pretty big, hefty tax relief for taking the risk of putting their money as equity inside of risk businesses. And those reliefs are still available, but Alistair, those reliefs have interactive IHT in a different way.
Yeah, yes, that's right. So yeah, EIS and SEIS shares do attract business property relief without necessarily having to fulfill the other criteria for that. But of course, they're also subject now to that £1 million allowance in your estate. So if you have, if you've got your main family owned or family run business or owner managed business, and you've also got some other investments you've made through EIS and SEIS, you need to think about aggregating the value of those and thinking how that aggregate value exceeds that £1 million allowance.
And certainly, Phil, in your conversations with individuals around personal financial planning, EIS and AIM listed shares, BCTs, etc., were always part of a broader IHT strategy, correct? But now things are changing.
Yeah, very much so. I mean, AIM ISAs we've used in some planning for a number of the clients that we've been looking at IHT for. Essentially, the rate for inheritance tax for AIM was previously 0. And what's happened now is that that rate has been halved. So the applicable rate to an AIM investment is better than the standard inheritance tax treatment, but it's reverted to an applicable rate of 20% rather than 0.
And the thing that really has irked a lot of our clients in this feels very retrospective, because people have been working with advisors for years and years and years, channeling assets to particular asset classes, EIS, VCT, AIM, putting money into pensions on the basis of some IHT decisions. And the changes today, a lot of that planning was either now meaningless or kind of has certainly changed in such a big way. The government wants you to spend your money, not pass your money on. I think it's the message we're hearing. Yeah. Okay. We've also got a question. Here's an NI related one. So Dan, maybe one for you. So with only 2 employees, how does it work with the NI increase? Is there an exemption up to a certain salary level? So the new limits and expectations for 2-person companies.
Sure. Yeah. I mean, obviously, as I mentioned earlier, we'll circulate a calculator for everybody that helps them calculate their specific scenarios. But again, as I touched on, really, if you've got less than 5 employees, providing they're not on extremely high wages, that's certainly going to be beneficial for you. You're going to be paying less national insurance than you were previously. Like I said, that there's a few different changes they've made. So typically now a higher proportion of an employee's wages will be subject to national insurance than they were before. But on the other hand, each individual company is given a higher band or a higher allowance before they as a company need to pay national insurance. So you've got a few kind of conflicting changes, but the overall impact, for companies of 5 or fewer employees, you're going to be paying less national insurance.
Okay, excellent. Alrighty. I think, have we got any more Q&A coming through? If there's anyone else wants to put some final questions into the Q&A, final moments to do so. We're there. Just actually, one of the other things that I spotted, I think, Phil, we were talking about this earlier, because again, lots of questions I've had around here, what's happening to my ISA? And ISA on the surface seems to be left untouched, right, Phil? But when you get into some of the details of the budgets and actually read the big document, the document will show you for various different tax laws the expectation the government will get from the return they get from any changes to that. And on the ISA line, there's 0 return today because they've not changed anything, like Phil. But there's some big worrying numbers in the future as they seem to be raising quite large amounts of money from some changes in the ICE in the future, right, Phil?
Yeah, that's correct. Yeah, they're looking at adjusting potentially some limits in the future. They didn't touch it in the recent budget, and this was one of the things that we'd heard murmurings prior to the budget that they were going to. So the message is from our perspective to our clients is take advantage of the environment that we've got currently, and if there's any unused allowance, it's incredibly sensible to use that allowance on an annual basis, because that could potentially reduce in the future.
Yeah, indeed. ISA, the best tax planning tool in the civilized world, as it often has been touted out there. Okay, so getting into the details of the budget certainly is an important part. Now, I've just got another question come in. Here we go. Can we check the CGT? Has CGT increased for property rental sales, Phil or Alistair?
That hasn't been affected for that. The CGT essentially, as kind of mentioned earlier, what they've done with CGT is just try to simplify it. So it's just bringing kind of everything else in line with what was applicable to the property market anyway.
All right. So I think we better wrap up now. We've got to all get back to it. But thank you again for joining. This is an open conversation. Please reach out to me or anyone else on this call. Reach out to the partner or client manager you usually deal with. There's a lot more to be said about the budget. There's lots of things that happened in property and nuances to do with LLPs and CGT that we will talk about more in time. But like with a lot of things, we need time to get into the nuance to understand the right thing to do for our clients. So thank you again, everyone, for joining. It's great to spend some time with you. Have a great day.